Today we are joined by Mr. Kerr Nelson and Mr. Andrew Clifford, the founders of Platinum. Kerr, you founded Platinum in 1994, and since that time we've seen the emergence of new markets, new technology, and what seems like increased uncertainty. Can you explain to us how Platinum has evolved over that time?
Yes, you're quite right. There's been a lot of change, but the one thing that doesn't change at all is humanity and the way it behaves in uncertainty. So in uncertain conditions, there's a fairly clear pattern of behavior. So what we've seen is the need for much more specialization. In the early days, we were often early arrivals in a new market and exploited that. What we've now done is broken the firm into sub-teams. So there's much more specialization, and the teams themselves vet the work as it comes through. We're using much more quantitative methods to help us identify where opportunities might lie. And it's all just, it really is just a concentration of effort in smaller packages.
Andrew, Platinum was one of the first fund managers in Australia to offer investors global equity exposure. Yet there's still some reluctance on behalf of Australian investors to invest globally. Can you explain that reluctance and the risk that potentially poses on investors?
So I think around the world, wherever you go, you'll find that investors have a great sense of comfort and familiarity. So there is always this bias towards the home market. For Australian investors, that can be a particular problem because we have a very narrow stock market here, dominated by the banks, the resource companies, the big retailers. So when they focus there, they're really missing out on a huge variety of opportunities are out there. And if you think of where, the great opportunities today are, whether it's around biotech, the internet, alternative energy, most of these opportunities are represented in stock markets elsewhere in the world. So by staying at home, you get a very narrow and less diversified opportunity set. And on top of that, you're often, doubling the bet up on, your own income sources most definitively comes from the local economy. So, that is the risk when you stay at home.
Gentlemen, a question for both of you. We've seen the growth of index products in recent years. Can you explain why investors should still invest in managed funds?
The real most obvious way of looking at the problem of index type products is that you will have your greatest exposure to a company when it is at its peak. So if you think of a company like Cisco, which we have in the portfolio today and are very enthusiastic about, but if you're in an index fund, today will be about the lowest weighting you've ever had exposure to Cisco, whereas at the top of the tech boom in 2001, it would have been your largest stock and on 70 or 80 times earnings as opposed to 10 times today. And that really is the perversity of index investing, as simply as it can be stated.
But I'd like to add as well that it's just been a wonderful opportunity for, the sort of neutral funds, because it's been a trending market and you just follow the winners and it makes it look easy. And you seemingly don't pay any fees for this, and it all looks perfect. But we think right at the end of that particular episode in markets, where trending now is less evident. So what has worked so well for a while may now prove to be less interesting. But Andrew's idea about your most exposure is that it makes you the most vulnerable is correct.
I would like now to spend some time on the research process behind Platinum, with a particular reference to the Platinum International Fund. Kerr, can you explain the investment objectives of this fund?
Well, we're really, in its simplest form, we're really just trying to give clients the opportunity to have a package of interesting companies. They're not necessarily the most popular companies because we feel they invariably are fully priced. What we're trying to do is find interesting companies which have defensible niches or positions in a market that for passing reasons, transient reasons, are not correctly priced. There's too much concern about very nearby events, and people are overemphasizing those short-term factors in a company that's got a 50-year prospect or whatever. And that's where we try to add value by separating out the intrinsic value of the company from these very noisy short-term news events and so on.
Kerr, can you talk through the investment philosophy behind the strategy?
Well, in a way, I more or less said it then, because what most investors do, and most human beings, is if they've had a shock, they tend to overreact to it. And the same thing happens in stock markets. When they've been rewarded with something, they treat it as if it's ongoing, and if they've been punished by something, they treat it as being likewise. So there are two things that we do as humans. One that's very evident is we overemphasize a nearby event, which we call a selective bias, so-called availability bias. And the second thing we do is we extrapolate. So if we're very happy at the moment, we tend to extrapolate that sense into the distant future. And if we're miserable, we tend to think that things are always going to be bad and so on. Those are the two things which we find in the human condition very persistent, and to our way of thinking, exploitable from a perspective of making money.
Andrew, you run a concentrated portfolio of around 100 to 200 names. Can you explain the stocks selection process behind the portfolio?
So, as Kerr has said, our focus is very much on those companies where there are near-term issues. So what's very important for us to understand is that there are not deeper issues that the market is worried about. So the process is very much driven by getting a deep understanding of the businesses, the industries that we're investing in. And in order to do that and to build a portfolio one by one, the investment team, which numbers 30, really at any point in time, they're all working away on individual projects, individual companies or industries, looking at the potential in those. And it follows a process, I guess typically of that, you've got this idea, you work through it. We talk to many industry experts, we're out there trying to test these ideas in the real world rather than just financial people. We're not looking at spreadsheets, we're trying to understand the way things really work. And eventually the analysts will bring this together as a note, a stock note as we call it, and typically comes into a meeting where it's not one of these meetings where we're all trying to agree this is a terrific idea, but we're really trying to find what's the flaw with what is being argued. And from there, we start to make decisions and build up the portfolio a stock at a time.
Andrew, your strategy focuses on absolute returns. Can you explain your net equity invested ranges and how and why they change?
So they will change quite a bit through time and really depending on the level of markets. So if you look at the long history of the international fund, the exposure has been as low as 60% for long periods of time, and then probably not often very much above 90%. And really what this reflects are the opportunities we see in the market. So at a stock level, if we're seeing many things that we want to own, we will be getting closer to that, spending our cash. And also, besides leaving cash, the funds in cash when we can't find stocks, we'll also be short selling companies. So if you can imagine in a market that's very excited, the stocks valuations are high, we'll be finding less opportunities to buy things and more opportunity to short sell, and the net exposure will come down. And conversely, in a weak market, we'll be finding more things to buy and a lot less to be concerned about and short.
I'd now like to spend a little bit of time on portfolio construction and risk management. Kerr, you challenge the market when you buy an unloved stock. How do you manage this process when the market clearly believes you were wrong?
Right. As Andrew said, it's all about the depth of work you're doing. So the essential thing is that when you're looking at your case, that you keep an open mind. And what we do is, as we've said, is you write up a report. And in that report, it's very clearly stressed what we really are sure about and what we are unclear about. And there are milestones. And when you start seeing the milestones not being passed, that's a very early warning sign. And that's when you have to start reviewing whether you've actually got the right end of the stick or not. Because you're quite right, that's the danger. And if you're stubborn for the sake of being proud, you lose money. And as a serious investor, that's the real mark of failure. It's not whether you made a little money or not. It's how much money have you lost on your supposed great insight. And we are very clear that we're not talking about absolute relative returns. We're talking about how much money have you made, and that's what matters, not relative returns.
Kerr, your focus is on absolute returns within the strategy, and you use short selling. Can you explain how you use short selling and how you recognise a short selling candidate?
Well, we find short selling difficult, as most people do, and what you're really trying to do again is exploit exaggerations. Sometimes there's a clustering. That's the interesting feature of markets. There's a clustering of an idea around tech or biotech, as we saw more recently. And when you see it just being a sort of feeding frenzy, that can tell you, together with your quant work about valuations and so on, that you're in an area that is vulnerable to a correction. It doesn't help you with timing. And that's the most difficult thing with short selling, is timing. And our experience is that we tend to short too early, and that does tend to damage the type of returns we can get, because it's psychologically quite hard to live with a short going against you. And so it does intimidate one somewhat. But we use it because we're trying to remove variability of outcomes in the portfolio, in the fund. So in plain English, trying to reduce the amount of wobbling in the unit price. And at some times when markets are very extreme, simply to make money out of prices likely to fall. And that gain offsetting some of the gains in your losses, in your long position.
Andrew, your strategy has a broad allocation across the globe. Can you explain how you manage currency within the portfolio?
So, I mean, again, this is one of the more difficult parts of managing a global portfolio. And, you know, what we generally are trying to do is have a view on the major currencies, including the Australian dollar, you know, what are likely to be, you know, the stronger currencies over the medium term. And indeed, you know, we're looking at many of the traditional variables that people look at with currencies: interest rate differentials, differences in economic growth rates, purchasing power parity and the like. But really one of the better indicators often is just when we're looking at companies. So if we're looking at Japan and we look at the profitability of a great company like Toyota, when they're struggling to make money when the yen is at 80, and you know most of the export sector are not making money, you've got a pretty good sense that currency is pretty fully valued and you want to stay away from it. Conversely, when it's at 120 and they're making out like bandits far more than they should, you probably know it's gone too far the other way. Now, day to day, week to week, even over a short periods of a year or so, that may not work that way. But you just try and move towards what you think will be the stronger currencies. And we do that simply by using the foreign exchange forward market. It's a fairly straightforward process in terms of how you go about doing that.
Could I add that currencies tend to be quite trending, so the trend persists for several years. It's not this very short-term wobbles that matter. When a currency starts to turn, that stays in place for quite a while. And you've seen it with the Australian dollar. So we broke up to close to 110 against the US. When it turned, you had a long trip downwards, and you need to find reasons why that's going to turn around before you start saying, well, it's now cheap enough, because there's actually a longer term driver.
Andrew, how do you manage risk within a global equity portfolio?
For us, risk is central to everything we do, and it comes back to the original approach to investing and what I was talking about earlier, which is know what you're buying. You have to know what you're buying. And that the better work you do, the more that you avoid being in the heat where everyone else is crowding, the more you take risk out of your portfolio. After that, in construction of the portfolio, you have to be aware of common variables across a portfolio. So, for example, sectors like property sector and banks are both very sensitive to interest rates. So you need to be aware if what the market is worried about is rising interest rates, as an example, and property and banks are both getting cheap, you have in some sense a common risk element to those parts of the portfolio, and you have to consider that in your overall construction. But really, to us, risk is, how well do you know what you own?
Looking around corners, again, avoiding this extrapolation, because many people are good at describing a company, but they don't understand its workings. What really makes this company different? What really protects it? Because there's a slogan around a brand, but it doesn't give you an insight into what really allows it to make these very high rents.
Kerr, the fund has a 20-year performance track record. In your experience, can you explain the unique characteristics in regards to its performance? When do you expect periods of outperformance and or underperformance?
What we find is, as a bull market matures, we start to become nervous because valuations invariably are high. There's a great expectation of things continuing for much longer than is probable. And that's when we start taking some of the bets off and building up cash and sometimes shorts. So we tend to sort of flatten out a little before the top of markets. And where we really make the big difference is in the downturns, where often we start to pick up some of the advantage of having cash and having some shorts perhaps. In the current environment, it's a little different because what we're seeing is very unusual markets. And what we would normally be doing now is buying companies that have been thrashed, because we'd say these are where the value lies. But in fact, we think there's a big change taking place where there's an oversupply of many of the goods and services that we would normally be quite eager to pick up. And so we don't think it's not different this time, it's just modified by there being plenty of supply, and it shows up in deflationary tendencies around the world. And so you've had to modify somewhat where you want to buy the good value. It may not be the cheapest, now it may be just very interesting companies that have got, relative to their peers, a lot cheaper.
Andrew, what sort of investor does the fund suit, and what's the recommended time frame for investors?
When we look at this type of companies we're investing in, we're typically looking at, these days, a 5-year type of time frame to see the potential of those investments come through. And I think certainly, someone who's considering investing with us should certainly be looking at no less than a 5-year time frame to be going into the funds, because simply when you're going into some of these very depressed areas, we don't always have a sense of when things are going to come good, but we just do know that the potential there is very good, but you do have to wait at times. And over the years, you've probably had to wait longer and longer for these turnarounds to occur.
Andrew, can you explain how the strategy can fit into a diversified portfolio?
Yeah. So I think that while what we do is not unique, there will be other investors trying to do the same thing. Predominantly, most other strategies that we see are people chasing momentum. So they're going after the latest trends in the market, and certainly index funds we would certainly see as part of those momentum type strategies. So we are offering something that is different to what many others are, and I think that in terms of combining different strategies, people can get a much greater, a much improved risk-return trade-off in their overall portfolios.
We give them more dispersion because we're not interested in the index. So we're the antithesis of index huggers, and so we just add a much greater dispersion of likely outcomes.